one of the biggest things that we've been hearing from our clients right now is we're talking to them about buying a house. Maybe they didn't buy in 2021, or maybe they were introduced to you in the last few months or something, and they're like, yeah, we're just gonna rent. Like, we're gonna hold off a little bit. Buying right now, like, are you crazy? We're gonna wait for the crash. How long are they gonna be waiting, right? It's gonna be just a little bit of time. So I want to kind of go over a couple of things to help the clients better understand the markets. I know you guys are probably aware of a lot of this, but never hurts to go over again. And these are important points to tell the clients and things that we've been finding have really hit home. So yes, rates are higher than they were a couple of years ago. Will they go back to that 2 and 3 level? Probably not. And rates are expected to drop throughout the year and into next year. But what's going to happen when they do? We all know the answer to that question. Inventory is super tight. I have a couple more figures to go over to kind of help illustrate that. But we all know what's going to happen when those rates do drop. Our already tight inventory will get even tighter. So much so that looking at from 2019 to now, we currently have about 980,000 homes available for purchase. And as you can see, other than 22, that is one of the lowest levels in recent history. So helping them understand that with inventory at 980,000 homes, the projected household formation for this year and the next few years, does anyone want to take a shot at what that projected household formation is?
Can you tell us what projected household formation means?
So yes, the amount of homes that will form. This could be the millennials that have been living with their parents and they're breaking off to start a new family. The newlyweds who are starting to make their own home. So basically just a new home being inhabited by a primary borrower. 1.5. That's not in there, right? It is. Did I not learn that? All right. Well, that was a pop quiz. Perfect. She's just very in tune with it all. So 1.5 million homes are projected to form this year. That is obviously more than the 980,000 that we have available, and they're not projected to get any better anytime soon. This is the permit starts and completions for April 2023. So I know it's a little difficult to read here, so we'll go through one at a time. The permits for the month-over-month basis, they are down 1.5%, but they're down 21% year over year for new building permits. Now, starts are also down year over year. They're up a little bit for month over month, but we had a lot of rain recently, and that's a really big factor for the month over month numbers here. So really, we want to focus on these year over year. We're down 22% in our housing starts, new homes that are being built, and the completions are even lower. We're at 1.375 million, and we are up just 1% year over year. So we're inching in the right direction, but that's not going to solve this problem very quickly. Especially when, has anyone heard of this new fun term, BFR, built for rent? That is like our arch enemy here. That is almost 10% of the housing starts for this last year.
Menifee has.
Yeah.
They're building them.
Yeah, and they are something that they're projecting is going to boom in the next couple of years, especially with. There we go. There were a couple of other stats here that's just basically illustrating that this build for rent thing is not a fad. They're projecting that this is going to be a thing that's sticking around for a little bit here. So we really have to be on top of this because again, 10% of the housing starts are going to this right now. So helping them understand that with that shortage here, builders cannot simply catch up quickly enough. And when the rates drop, the prices will continue to rise. And it could be more competitive than when it was in 2021 because people aren't moving around. So what can we do? So we know the inventory is tight and it won't be a quick fix. What can we do? And these are a couple of things that we wanted to illustrate here. We're going to play the cards that were dealt, obviously. So the pandemic homebuyers as of September 2020, 55% of them regretted their purchase. They took another survey in February 22. That number went from 55% to 75% of people that bought in 20 and 21 had a regret about their purchase. Now, couple that with the fact that, so we have 3/4 of our clients who probably have at least one complaint with their home. They were rushed into it, the repairs weren't done to their liking, it's not fitting their needs anymore. 82% of those that would sell and buy something else are saying that they will not because they feel locked in by that mortgage rate. So obviously, this is probably the biggest hurdle that we have to tackle. A lot of people just see the number and right in their mind, they're thinking, we can't move. It's almost double rate or it's double our rate. We simply can't do it. Well, there's a lot of other things that came into play over the last couple of years. One of them being the personal savings rate, looking from the beginning of 2018 to beginning of this year. As you can see, the stimulus checks really helped us out here as a country overall. And now we're at this really low level of savings rate, and couple that with the credit card balances that we have. If you took out this little blip here, which funny enough, kind of corresponds with the stimulus checks that we got. If you cut that out, you could draw a straight line to where we are now. And it's not projected to get any better anytime soon, especially with this recession, either here or on the horizon, depending on who you ask and look to. But there's another factor that we have right now to our advantage. This is equity since 1950, I believe, over here. So obviously a lot less inventory over here. And we are near the absolute historic highs of equity that we have had. You look at the 2006 to 2008 crisis here, yes, it dipped down. And that was one of the big problems with the 2008 crash and the loans that were going on in the early 2000s, is they were allowing people to basically not have equity in their homes when they purchased them, when they refinanced them. That has obviously changed. So the conversation with these clients who bought in 20 and 21 who feel trapped by these rates needs to be focused around a debt management plan. So this is the first program that we have that we're going to use to help them get into this new home. So using the equity in their departing residence, these buyers can eliminate other debts and or put down a sizable down payment to help keep those payments the same, if not lower. So those also who refinance into a 10-year, 15-year, or 20-year loan will not feel the jump in rate as much as those who have a 30-year loan. So anyone that we have that has a 10, 15, 20-year, definitely kind of work together on that as well. But these people, they have already high payments. If they want to get into a newer house to meet the needs of their family now, this could be something that pushes them to do that. And then if and when the rates do drop enough, they can refinance down to a shorter term or just keep paying it down to get back down and pay that off sooner. But they need to be aware of their blended rate. Does anyone have any idea of what I'm referring to when I say blended rates? Perfect. I made it up myself. So the blended rate, we're going to get into an example here. The Baggins family, who originally purchased their home for $500,000, owes about $350,000 right now. Their rate is in the low threes, 3.375, and they're going to sell their home for about $680,000 right now and net about $300,000. So they would love to upgrade to something that's around $750,000, but they don't want to give up that rate. So what can we do about this? Looking at their overall financial picture, they have that loan, yes, at 3.375 and $350,000 loan amount, but they also have 4 credit cards and this car loan. So with that 26% rate, 24, 21, 24, and 9% rate on this car loan, what is their actual interest rate that they're paying on all of their debts combined? 7%. And these are average statistics for a lot of our buyers right now. Most people have about $50,000 in credit card debt, especially in areas where they have access to all of that. Car payments are relatively high right now. So when we put this all together, they sell that home and now they're looking to buy something else. Their new purchase, that $750,000 purchase price, how should they use that equity? Should they apply it straight towards the down payment? That is kind of the knee-jerk reaction. So a lot of people think if I throw everything at the down payment, that's going to give me my best overall monthly payment and financial picture. Well, looking at this, if they did that, if they threw basically the $300,000 that they're going to net from this sale right at a $750,000 purchase price, give or take, so they use some for their closing costs as well, they're still going to be paying $40 more than they were before. So it gets them close, right? Their payments are about the same as they were. They got the bigger house, but they still have $3,500 in other payments that they're making. So what happens if instead we put the equity and we split it towards all of their debts and then the rest towards the down payment? Now they're saving almost $2,600 a month because their blended rate was 7%, and this rate right here is still around 7%. But they have fewer payments to make, and their overall savings again is it's $2,600 that they're going to be able to hold on to. And if they're savvy and they're okay with that payment that they had before, now they can throw that back at their mortgage and pay it down faster. So the big picture here is really those clients that have the equity and they're holding on because, again, that low rate is just phenomenal and they're really excited about it. They talk to all their friends about it at parties. They could be in a really good position to improve their overall financial picture. So what we want to say to them is, I totally understand that you don't want to give that up. Do you know what your blended rate is? They're going to look to you like you're from out of space and you're speaking Greek. They're just going to say that you're what? So you say the combined rate of all of your debts. Here, give my lender a call. They will help break it down for you. And we will literally run their stuff through a system like this. And we can show them if you pay this down, if you pay this down, what's going to happen to your overall picture, because math speaks for itself. We can tell them things that all we want, but especially in times like right now, people think that we're telling them what is best for us, not what's best for them. So we can meet with them. We can do a soft credit check to see what they have, what they owe, and all of that. And you can give them a CMA, let them know what they might be able to sell for. And then we can work this up and show them. And maybe it won't work. Maybe it's, the payments are still going to be relatively high, but at least they're getting their heads out of the sand and figuring out where they stand. There we go. So the next program that we want to talk about are bridge loans. And my mom will go ahead and take over for this one.
How many of you are familiar with bridge loans? How many of you have ever actually done one? So they aren't real common, but we do have some, and sometimes it's the right loan for the right person. So this is for the client who has a lot of equity in their current home. They're going to be selling their home. They want to use some of that equity to buy another home so that they don't have to close concurrently. Okay. And there's two different options when we're doing that. If their home is just listed, they can borrow up to 70 or 80%, depending on their FICO scores, of the current equity in their home. So if you list somebody, we can use, we have to get an appraisal, and then we're going to go 70 to 80% of that appraised value minus whatever they owe, and they can borrow that in the form of a bridge loan second. When the house is listed but not in contract, they're going to have to qualify with their current house payment, plus the bridge loan payment, plus the new house payment. So it's going to be a little harder for people to qualify for all of that, but you might have some super qualified people, but that's not a problem. If their house is in escrow, we can go up to 90%. And they do not have to qualify for the new loan with the departing resident payment. So makes it much easier for people to qualify. And the bridge loan payments, or the cost for them, I believe, is 2%. So they're not cheap, but it's allowing them to do something that they wouldn't be able to do otherwise. And the minimum loan amount is 150, the maximum is 750,000. So again, they do have to have a substantial chunk of equity, and that's a product that we do have available that we can use. So here's an example for somebody. They have a home that's worth $2 million. They keep losing to non-contingent offers, so they want to be non-contingent so that they don't lose out on their offers, and they need to utilize the equity in their home. They owe $200,000 on their $1 million home that they're going to be. It's not in escrow. They can access up to $800,000 minus what they owe. $600,000 is available through the bridge loan for their new purchase. Okay. So what you might want to say to your clients is, I know you might rather wait until your home sells, but then the pressure is really on you and the market's heating up. Do you really want to keep losing out on your dream home to non-contingent buyers? Any questions on how the bridge loans work? They don't take any longer, so you know, it's a great product for the right person. It's not the right product for every person. But it will work in some cases. The hardest part's gonna be, I would say, the majority of people don't qualify until their house is in escrow. So, you know, you're still gonna have that interim time where you're gonna have to be able to get in escrow right away on a new house, or you're gonna have an overlap period that you have to deal with. Jackie and I are working with a client right now who's in that situation. You know, it's an older couple, they have a lot of equity in their house. And you know, her biggest concern when I talk to her is, I don't want to feel pressured to find something when my house sells. And of course, Jackie listed her house yesterday and had 7 showings yesterday. So that house has probably got offers already since yesterday. And she hasn't started doing anything quite well. She went out looking at you yesterday as well. So, but that's one of the options that we gave her, is she could do a bridge loan. Okay, any questions on this part of how this one works? Okay.
But first, I have an assignment for you. The first 3 people to email me the 5 programs and who they are specified for will get a prize. So go ahead and keep watching and then send me that email once you're done.
The reverse mortgage. How many of you are familiar with reverse mortgages? So we do quite a few of those. At our company, we have different levels that we can get approved for. For somebody who doesn't have any experience or training in reverse mortgages, they just would pass the name and number along. We have a reverse team that handles them. I've had specialized training in reverse mortgages, so I'm at our middle level, which means I can talk to the clients. We have a back office that prepares the 100-page document that goes to the client. They prepare that, and then I explain it to the client, go over everything. So I'm still the loan officer for them. But I don't do the processing myself. Our reverse division handles that. There's some people in our company that's all they do is reverse mortgages, and they do their own processing and have their own team that do it. And so that's the 3rd level. In my opinion, it's just my opinion, people that do the 3rd level, whether it's through my company or any other company where that's all they do is reverse mortgages. If that's all they have to sell, that's what they're going to sell. And I don't believe it's the right loan for everybody. Reverse mortgages are very expensive, and that's what turns a lot of people off. But it's a great loan for a lot of people. The thing that I like is, like for me, I don't make any more whether I do a reverse mortgage or a traditional mortgage. It doesn't matter to me. I'm going to do what's in the best interest of my client. So the way the reverse mortgages work, you have to be at least 62.5 years old. Now, we do actually have some proprietary loans that go down to as young as 55. So there's 2 types of reverse mortgages. The majority of our loans, our reverse mortgages, are FHA insured. And so they're called a HECM. So if you hear that term, it's a home equity conversion mortgage. The other type is our proprietary. And so the HECMs, the FHA based ones, they all follow the same rules that FHA puts out there. And the proprietary ones, they can have their own set of rules. They will be less expensive than my FHA product. They will also have a much higher interest rate than my FHA product. So different situations in where I would use one over the other. It's good for somebody who's on a fixed income. The way you qualify for a reverse mortgage, let me back up just a second. A reverse mortgage, in case you're not familiar, means you're going to borrow a certain amount and you never have a house payment. You're responsible for taxes, insurance, and HOA. You won't ever have a house payment. You can never, it's probably in my slide because Tyler created my slides for me, but you can never owe more than your house is worth. So even if our market completely crashes, like what we had in 2008, if the value of somebody's house goes down and their mortgage balance is higher and they want to sell for any reason at all, it's a guaranteed short sale. You don't have to get an approval, you don't qualify. You could have millions of dollars in the bank and you say, my house is upside down, I'm walking away. Now, because of 2008, they made a lot of changes to the reverse mortgages and they no longer go as high of a loan to value. So the people that are doing them are going to have a pretty substantial amount of money that they're putting down. It's between 40 and 60%. 40 and 60%. So the younger you are, and I'll tell my young ones, my 60s and 70-year-olds, well, you're at the young end of my reverse mortgage. They love it. They light up when you tell them you're at the young end of something. But they're gonna bring in 60% in order to do it. I actually talked to one client the other day. He's over 62, he's 65, but he married a young one, so his wife is only 55. They still qualify, but the amount that he has to bring in is more because the loan is guaranteed to be in place until the last person is living in the home as their primary residence. So I tell people, if somebody, if your intention is to move out of this and turn it into a rental, that won't work. But if you, let's say, I've done loans for people in their 90s. They want to live in their home and bring in-home care while they're living in their home. They can do that. But if they have to move into assisted living, do not put a rental person in that house. If mom and dad's living in assisted living, bring them home once a year, let them celebrate their birthday in their house. You start that clock over again. And be really careful about changing their mailing address because that's what'll trigger. Okay, so I advise my clients on all those things. But the qualifying for these is super easy because all you're qualifying for is do you have enough to pay your taxes, your insurance, your HOA, and whatever other expenses you might have, car payments, things like that. And then they come up with how much they think you need to live, which is like $500, $800 a month, depending on how big your family size is, left over at the end of that. So if somebody's on Social Security, they're probably going to qualify. They're not credit qualified. They could have terrible credit. They would still qualify for a reverse mortgage. However, if they have poor credit, or if they've been late on paying a property tax bill or a mortgage payment, they'll have to have what's called a LISA. And that's a lifetime set aside account to cover their taxes and insurance, which means they're going to have to bring in even more. Okay, but it's another option for somebody who just has terrible credit. I did a loan for someone several years back now. He had done a reverse mortgage in the early 2000s, probably even before that, not with me, when they were going much higher loan to values. And he lived in the Bay Area. He got to be into his 90s. He wasn't taking care of the property, wasn't taking care of himself. He needed to move back to Southern California so his family could take care of it. Well, property had gone bad. We passed the 08 time period, so his value dropped. It was a guaranteed short sale. They sold his house. It did not affect his credit. He had VA eligibility. He came down here and he bought a loan, 100% VA financing. That loan did not affect him at all. Okay, so it's a great option for many people. The client that I was telling you about before that's with Jackie, that's one of the options that I gave them. When I talked to the client, she's like, well, why wouldn't everybody do this? I said, well, because people don't know about it, number one, because it's expensive, number two, and some people have other sources of income. So she's debating between doing the reverse mortgage and the bridge loan where she would have a traditional mortgage, and she'll go one of those two ways. The thing about the reverse mortgage that you need to know is if your clients are interested in it, you need to get them started on it right away, because after we talk to them and tell them how the program works, and we do our 100-page proposal for them, of which about 75 pages of it is a HUD booklet talking about reverse mortgages in general. It's, print's really big and it's got lots of pictures, so it's not as bad as it sounds. They have to go through HUD counseling, and HUD counseling is a private entity or another agency. It's not private with HUD, but they have to counsel the people. When we prepare our proposal, it'll have a number on it, a code. And so the counselor will access that code. So they're telling them information applicable to them, not just general information. And then there's a 7-day cooling off period for them to think about it. And that's 7 business days. So it's really about 10 calendar days. All that has to happen before we can make our application. So Audavita, if you bring me something, you're like, hey, they're in contract, they want a reverse mortgage, you have to have 45 to 60 days if I'm starting from day one, and you have to know I can't start my application until the counseling's done. I can't start my application, an FHA loan, I can't order my case number, can't order your appraisal. Okay, so we encourage our reverse people, even if you're not sure you want it, do the counseling, start the clock, have options. This is a great option for people. Any questions on the reverse mortgages? You know, we have a lot of people in our community that have, so this, I'm gonna use Jackie's plan again. She's expecting to net about 400,000 and she's looking at homes in the 600 range. Is she going any higher than that? Okay. And the reverse mortgage only requires her to bring in about 360,000. So she could either bring in all 400,000 and she could have a larger loan or a smaller loan. She could have a larger loan, have $40,000 in the bank, but they have good money in the bank, so that may not be important. Or she could do the larger loan and only to access what she needs. And the remaining part of that, the other 40,000, is going to be put in a line of credit for her. And then down the road, if she needs to access that line of credit, it's already there. She can access it for whatever she wants. She could take out a little bit each month. Oh, I need a repair done on my house. Let me take it out of there. Oh, I want to go on a vacation with Lacey. Take it out of there. So reverse mortgages gives people a lot of options. So it's a great product for the right person. The bank will never own your home. Okay, that's the biggest misconception that people think. I think years and years ago, it was like that. It is not like that now. If the people pass away, their heirs inherit the property. If whatever equity is in the home is theirs, just like any other loan. The difference is if you borrow, the reason the loan seems so expensive is, let's say I do a traditional loan and I borrow 400,000. I'm gonna make payments, right? So other than day one, that loan balance will always be lower. I'm gonna pay fees on 400,000. Well, on a reverse mortgage, I'm gonna borrow 400, but I'm never gonna make a payment. So that loan balance is always going up. You're paying fees on a higher amount because that's where the loan balance is gonna get to, not where it started. That makes sense? But the bank will never own your home. Now, the worst thing would be, let's say that your heirs own that, you know, that you pass away and the house is upside down, but you've grown attached to this home. It's for your parents, you've grown attached to it, it's your family house, you really want it. You can buy it for 90% of appraised value. Refinance it for 90% of appraised value, even if you want to keep it. So the FHA part of it has a lot built in, all to protect the client. I could do a whole class on this one, but I better not, so I'll keep it going. So what you would say is a talking point. I know reverse mortgage used to have be a bad word, and a lot of people still remember that. They're very hesitant. But make sure they know they've been completely upgraded in the last several years. It's not even, I wouldn't even say few because it's been a long time now. Wouldn't you like to not have a mortgage payment? Give my lender a call. They'll walk you through the process and at least let you know your options. All right.
Awesome. On to the next one, renovation loans. Now, I'm gonna preface this. We're not gonna go super deep on renovation right now. We're planning one in the future to really get to the nitty-gritty of all the renovation products, if you guys are interested in that one. But I want to touch on them because they are a great option right now. So they are for the client who wants a fixer-upper, of course. So we have a few options. We have the 203K limited or standard, and then we have the conventional choice renovation. So I'm going to go into the differences here in just a sec, but there are options for everyone from a first-time home buyer to an investor. Not all of them will help an investor. Some of them, or all of them will help the first-time home buyer, but some of them are particularly for the investor or second homes compared to the others. The max loan amounts are calculated on the home value after the improvements, and conventional goes off the lower of either the total acquisition cost or the completed appraisal value. So whichever one comes in, typically they're pretty close though. Loan limits do apply. So that is one thing to keep in mind. Of course, if the home is selling already really close to the loan limit and they're going to factor in 50,000 in repairs, and that's going to put them over the loan limit, it's just not going to work. So which one is best? So a couple of things to go through here to really determine which one is probably your best bet. For the standard 203K, this is for your full remodeling. This could be if you are tearing this thing down and rebuilding something completely new. This is literally anything you want to do to it. You can do with a 203K, except, well, I shouldn't say anything. You can't do luxury items, so you can't do putting in a pool, you can't do a tennis court, you can't do anything like that. But if it is an improvement to the actual home itself for safety regulations, for upgrade reasons, those are perfect for the standard 203K. It is probably the longest one of the three, but that's because it's the most intensive and allows you to do the most. The minimum for that is $5,000. There's no max as long as you're within the FHA loan limit of your area. And it can be used to turn a single family residence into a multifamily residence. So I know that's a really big thing right now. Yes, Tina.
What if there is a pool already, but it's like a,
If they're repairing, they should be good. It's not, it's putting in a pool, that's where the issue comes in, so.
fix it, you can't add.
Exactly. And then, yeah, I mean, even if you're demolishing this thing, like if you're walking in and you're like, I'm surprised this thing hasn't fallen in on us, this could be a really good option for them. The limited 203K, this one is really overlooked, and it's a really, really cool option because it's for minor remodeling and non-structural repairs. The whole list of things you can and can't do with it, but essentially if it's more of a cosmetic thing or health and safety, but it's not a full addition or it's not landscaping, anything like that, it should be a good candidate, or it could be a good candidate for the limited 203K. The difference here is while this one has a minimum, this one has a maximum. So there's no minimum for this, but a maximum of $35,000 in repairs can be done with the limited 203K, and everything must be completed within 6 months. So like the standard, you cannot do it for landscaping, recreational, or luxury improvements, unfortunately, but it is a fantastic option for the person that wants to buy their first home because, well, or a new home to live in, because these are FHA, so they are primary residence only. So if you're buying these and it's a home that needs a lot of work, this is a great way for them to get in on a steal of a deal before someone else says, well, an investor comes in, buys it, fixes it, and flips it, and now they have to wait even longer to buy it. So this can help them get in under budget on something that they love, as long as they're willing to put in a little bit of work. They're a little bit of a headache, so you have to bear with them, but they can be a great option for them. Yes.
Still the same hoops to jump through between standard and limited contractor bids, estimates.
There's still some of them, but they're not as intensive with the limited because you're not doing as much. So. Yes, Jen.
So these are FHA.
These two are, this one is not.
All things.
That's where this one is.
This they do.
If you're fixing it, yes. Yeah, you can't just say, oh, we're gonna leave the dry rot or the fascia boards. I love that one. You have to address those, and it has to fit within whatever your parameters are. And then the choice renovation is a really cool one. This is any type of repair or renovation. The only caveat is it must be permanently affixed to the home. So again, no pool additions, no tennis courts, no second garage or anything like that, unfortunately. But any type of renovation is eligible for this program. Now, there are higher loan limits in pretty much every county around here. So that's a really good reason to kind of go with this one if they need a little bit more money. And it also can be done on manufactured homes and investment properties. That's a really key thing because these other ones, again, they're primary. This is for your investor who wants to fix it up and then buy it. They have to put 15% down, but yes.
I'm so sorry,
Are you
when
good?
you do an ADU, would that be included in that?
I believe so.
If it's attached.
Yes, if it's a permanently affixed, yes. So, and yeah, even this one, I think you can as well, but they have to be affixed, yes.
Permanently affixed to the existing structure or to the
Correct.
ground.
No, to the structure. So, and again, we can really dive deep into this in another one if you guys want, but just like the reverse, we could probably spend a whole hour plus going into all of these ones. Jenny, do you have something? Okay. Yes.
For the manufactured home, we still have to meet regular 78 guidelines of 76.
1976, yeah, June 15th, 1976. But I believe you can use it to put it on a permanent foundation. I have to double check on that.
Everything.
I think you can. So that's,
Requirements still have.
yes, exactly. So yeah, they have to meet whatever agency they're being sold to. This is a Freddie Mac one, not Fannie. So they have to meet whoever they're being sold to's still parameters, otherwise we get to buy it back. So we're trying to avoid those. So a little bit more on the renovation loans. This again, I mean, it's kind of a no-brainer, but really helping them understand you can get in under budget. I mean, if this is something that, you know, you're looking at a house that's X big and however many bedrooms. But to actually get one that's done and move-in ready is gonna cost you $200,000-300,000 more. This could be a phenomenal option for them. And again, if they're buying as an investor, it's 15% down, they fix it up and they're rocking and rolling.
Is
Yes,
there a hit on the rate or the fees for those?
the rates are relatively competitive. They're not too far off or anything, like 9 or 10%. But I mean, they are relatively costly, you know, because you're fixing it and there's unforeseen costs, you know, all that fun stuff. You guys watch HGTV and there's always an issue, so, you know. But
So it doesn't have the same rate as an FHA loan, it is gonna be a little bit higher.
Yeah.
It's fairly close. like you said.
It's not
Yeah.
very,
you know, I priced it out earlier this year for a couple of my friends. They're up in San Mateo County. And it was pretty close to what they were looking at otherwise. Yes. The- And the EEM. So these can be done for, they can all be done for those purposes as well, like adding, I think solar is one of them even. You can do a green renovations and things, but the EEM and those types of loans themselves are different. They're not exactly this. And we have a division that does those. So yeah, the EEM is a very interesting program. So, okay,
before you go to that one, can I add a couple of things?
of course.
So we've done, again, APM is a large company. We have over 1,000 loan officers. We're in all states except New York. And we have a renovation division and we have a construction division. So when we get these one-off type things where it's not what we do every day, we utilize our resources and we go to our partners at our company that do this and that's all they do. I've done some construction loans. My husband hates it when I do them because I'm like, I don't know any of this here, you do it. And that's what they do. So, but with the renovation or with the renovation loans, a couple things like, years ago, we used one for somebody who bought a house that it was a fourplex down in Oceanside. And the people started renovating it and they literally took it down to studs, ran out of money and they were selling it as studs. And we were able to use a 203K loan for them to build it back up into a single family home is what they built. We've also done one for somebody who bought at the beach and they added a second story. So some major constructions. I did one up in the Big Bear area and he bought, it looks like a little Thomas Kincaid house, like all rocks and it was super cute. But something to remember is these homes take longer. Okay, but how many of you have heard, whether it's from us or wherever else your other sources are, that interest rates are expected to go down? Okay, so what if you have a client that's like, oh, I really like this home, but it would need this, it would need that. Okay, can you live with it right now? Get into it. Now you have the time, 6 months, because we don't want the EPOs, please. So you have 6 months to get your bids from your contractors, do all your background, live in the home, figure out what you want to do. And then as those rates dip down, we can do the refinance on these same loans. So if it's a home that's fine, it's just outdated and the people want to do something. This is an option for them to be able to move in now. Maybe they're getting a house at a better deal because it's very dated and then upgrade it. There's a great opportunity for them to upgrade the home and make it their dream.
So what would the closing days be on something? Still be 30?
If they are doing a renovation loan, no, because most of them require contractor bids and you're not going to be able to get contractor bids until you're in escrow. And then that's our wait period. I mean, that's what delays us. The one that I did in Big Bear was probably at least a 60-day escrow. It was almost a year ago. We should be almost done upgrading now. So, I mean, but he could do, so Elisa, to your point, it's an FHA loan, so it gets an FHA appraisal. And the appraiser says, these are the health and safety issues. These are the things you have to do. Add on whatever you want to do. And they go to like 110% of the appraiser does the appraiser as if the work was done. So you're going to add another bedroom. So that's part of the problem is before I can do the appraisal, I have to have the contractors, but I have to know what you're doing. What kind of countertops, like you're redoing your kitchen, great. What kind of countertops are you putting in? What kind of appliances are you putting in? All that affects the appraiser. He has to know what the house is gonna look like when it's done. And then they build in a contingency and all of those other kinds of things. So it's a great loan, but it will take longer. So it's gonna take a special home to be able to buy it using this loan. It can be done. But in today's market, that may not be realistic. But if you've got somebody that's like, oh, this kitchen's ugly. What? Have you heard that rates are gonna drop? Because I've heard that rates are gonna drop. Let's get you in with the ugly kitchen. And then here, we'll have this other loan that you can do a few months down the road to get your kitchen pretty again. So,
And really quick, these ones go to 110% of the future value. This typically goes, if it's primary, up to 95%. So this one's gonna give you a little bit more leniency there. So, and the next set we have bank statement loans.
all right, how many of you are familiar with bank statement loans? It's our closest right now to a stated income, okay? You know, I've done a few of them. They're not fun. They're harder because you have to get a lot more documentation. Because I need 12, sometimes more, business bank statements, personal bank statements, all pages. So the borrowers are bringing in a lot. But this is a great program for your self-employed people. Like I hear from many people, oh, I made a lot of money, but my CPA is really good. I don't care how good your CPA is, if you're not showing something on your tax returns, we're going to have an issue. But there's other situations that this could be used in as well. One of my clients I'm working with now, she's a psychologist, and she has had her own private practice for years. And she also worked for an agency that paid her on W-2 for years. So when I've done her previous loans, I have 2-year history of working both type of jobs, which is important. I had her W-2 income and her self-employed. Well, this beginning of last year, she got a new contract with the VA that replaced her W-2 job. The VA pays her on a 1099. Now I have all self-employed income, which was the lower part of her income before, and now she's making $20,000 a month, mostly from the VA. So until she files her taxes next year, or yeah, because I need her 2023 to show her whole year, because she changed kind of in the middle of last year, I won't have enough income to qualify her. So there's different, the bank statement programs have all different variables, and we have several different investors. And one of the things that Tyler is really good at is research. So I'm like, here, figure this out. And so he goes to all the different investors, and this one goes off 100% personal, this one goes off 75% personal, this one goes this. And so for her, I needed one that went off 100% of her personal income, meaning she has to have a business account, and all her deposits go into her business account. She pays her bills, and then whatever's left goes into her personal. So they're assuming that all of that is her income. Okay. In this client's case, she didn't have a business account. She only had a personal account. She put everything in there. So our reps are really good. Our account executives, we lean on them heavily. So the account exec's like, okay, here's what you need to do. She needs to open up a business account. She needs to put all her deposits into her business account. And then when whatever's left, she paid, I mean, she's a psychologist, she works remotely on Zoom. She's like, I don't have any expenses. She really doesn't write very much off. She's one of my few. And then I said, pay your couple of expenses, then put it into your personal account. Now I can use 100% of that income. So that program worked great for her. She's buying, she's also at the beach. Beach people are my weird ones. And she's looking at $1 million homes, 20% down. She's got very good credit for a bank statement, which, you know, that's all we're verifying. Take a guess where you think her rate might be.
7.
Okay. 6. Okay. So we on this side, come on, 7. Okay. So I would have thought it would have been much higher actually than 7.5. And a couple years ago, they were substantially higher than the conventional rates. But they've really come down, and her rate's going to be 6 7/8. For I mean, that interest rate would be up to $2 million of a loan. So they don't go off conventional. So, you know, if she buys a house for $1 million, it'll be 800, which is still in my conventional limits, but none of those rules apply. The other thing that they do different, because she owns rental properties. So on a traditional loan, we're gonna go off what you show on your tax returns for rental. Which may or may not, that's where people get a little creative, like I have. Damn, rental needs all kinds of things, it needs plumbing, it needs gardening, like. All these expenses come off my rental, right? Nobody from the IRS, right? So. Yeah. But you can write a lot off on your rental properties, that's why some people have them. And then when we're doing a traditional loan, I'm gonna go off what your net profit is. You have a property manager, if you whatever. With the bank statement program, they're gonna take, if I have a lease and 2 months proof that that's how much she received from that rental. They take that rental income that she's receiving minus her house payment, minus HOA dues, and whatever is left, they're gonna give her a qualifier. So she had like $100 positive on one and $400 on the other, gave me another $500 of positive income. So the way they qualify, that you take everything you know about loans, you throw it right out the window, this is totally different. But don't be afraid of them for your self-employed buyers. And even some non-self-employed people, like this is a great option for the right person. They don't take any longer, so a traditional 30-day escrow would be fine. Our traditional loans, our conventional and FHA, we can close in less than 30. I wouldn't do less than 30 on this. But with this one, we've already submitted all her bank statements. They calculated the income, they scrub it. They're looking to see, is there anything on here that's not what they consider income? So like she received some social security for her son, they saw that, they pulled that out. So they do go through the deposits. They're looking to make sure that they don't see money going in and out of one account. You can only use one account. So these take a little bit of counseling for clients sometimes, but not always. But don't be afraid of the rates because they're not that bad. Because it's her primary house, there's no prepayment penalty. If it was an investment property, they do have prepayment penalties. You can buy them out. Tyler, you were looking for a client this week that was looking to do a bank statement loan.
On an investment manufacturer.
On an investment manufacturer. That's my only product I have that will do an investment manufactured home.
Went back real quick to the lady and she didn't take money and opened a business account, moved the money over and then pay herself and do all that. How many months of statements?
I needed 3.
So 3 months, she got to do that.
So yes, so she opened her account in January, so I couldn't use the January statement. I needed 3 that didn't show that opening statement, so it kind of made it where I needed 4. So, and then that's gonna be a rolling one for her. So, every month her bank statement will run out. And I'm gonna need a new bank until she gets an escrow. I'm gonna need a new bank statement and I'm gonna drop off the top one, which works in her favor because her initial ones were lower because she makes more money now.
Our credit scores the same, like that.
Credit scores are important for the bank statement programs. So,
Minimum 640, I believe, for some
Yeah.
of ours.
and they will do 90% non-owner.
As low as 10% if you have over a 700, I think it is, so. I mean, that's phenomenal, 10% down. We can go 10, yeah,
Except on the investment manufactured, that was 30%.
any manufacturer drops to 30% down, so
So.
I think I had that, so.
Sometimes we can use multiple accounts. Again, you have to build a picture. They're gonna, if you use multiple accounts, they're gonna really scrutinize them to make sure you're not pulling money out of this one to put it in this one, to take it out of this one, to put it in this one, to make it look like you're making twice as much money. Smarter than that. So if you can do it all with one bank statement, again, so it takes a little coaching sometimes for these people, but not always. If you've got somebody with a legit business, they take off a certain percentage. If it's a business account, 25, depending on the type of business it is, I think it's 25 to 50%. Unless you have a CPA letter that states that your expenses are not that much. You can build a case. This is, these are people that are reviewing it, not computers.
And they get it back to us quick. We've learned to love working with the non-QM, that's what these kind of called, because they want to earn the loan, so they're getting us stuff back really quickly, which is really nice, so.
So a talking point for this one, I know getting a loan when you're self-employed like us can be tough. But have you looked into a bank statement loan recently? Again, the key word there is recently, because the ones a few years ago, the rates were substantially. It's not that the rates have changed that much, it's that the conventional rates or the conforming rates have changed. To where when the rates were in the 2s and 3s, these programs were still up here in the 7s to maybe 8s. And now our rates have come up and their rates have stayed.
One thing on that, the 10% down, either rate's gonna be around 10% right now. So I mean, it starts really dropping once you get to 20% down, but just something to keep in mind. Those, I mean, they are relatively high, but if you don't have another option, they're a fantastic option, so. Cool. Thanks. Okay. All right, well, that was 5 programs for those of you counting along at home. But we have one more here, extra credit, because you all know that I could not let you leave without talking about down payment assistance. Because as we all know, again, with the rates projected to drop, who is going to be the first one on the chopping block when we're now throwing $50,000 over each asking price? Raise your hand if you loved writing an offer in 2020, 2021 with a down payment assistance plan. Exactly. I mean, and there were some, but I mean, as the listing agent, you're looking at this going, you have no appraisal gap. And you're looking at this person that's 50,000 over and you're like, hey, you got cash, well, good. And there are some, but unfortunately, the miracles, there's a reason they're miracles, right? So remember on these, they need 2 to 5% total of the house, the purchase price, not 3 to 5% plus closing costs. So there are options for first-time home buyers and non-first-time home buyers, which is really important. CalHFA is only first-time home buyers. Everyone has to live in the home and everyone has to be a first-time home buyer. Platinum does not have those restrictions, but you have a payment on the second. So there's give and take with all of these. Terms are obviously more favorable if you're looking for a first-time home buyer. CalHFA does allow 2-1 buy downs if it's not the dream for some. And you can go up to 50% debt to income ratio as long as you have at least a 700. This is pretty much standard across the board for all the down payment assistance now, which is really, really cool. Before they used to be 43, 45%. And down payment assistance, typically they need a little bit more help. There's also options for non-occupant co-signers to help. That kind of went away for a little bit, and then they realized, hey, this is something we really need. You know, you got your kid going to buy their first house and the parent wants to help them, but they can't say they're gonna go move into the house and they're not a first-time home buyer. There are options to help them still, or again, I should say, because they were there before. Single family residences, condos, townhomes, and manufactured homes allowed. There are different programs for each one, but they are all there. So if you have someone looking for a manufactured home in Wildomar, they can do that. If they're looking for a condo, as long as it's either FHA approved or whichever agency you're going with, we can do that as well.
First time buyer still.
Yes, and I will say, just in general, the way that you verify that, now, you don't give tax returns, you sign a form that says, I verify I have not owned a home or been on a mortgage in the last 3 years. I'll just leave it there. And there are no low level.
But they see it on your credit report, right?
Yeah, and then when they see they see that, and then if they see the address change after that, these ones, reverse mortgages, they are adamant about that because you're not using the money properly. So, but one of the best features of these, is no loan level pricing adjustments. I know that's been a really big trigger term recently, but in this instance, basically, if you qualify for the loan, you are going to get this rate, whether you have a 640 or 740. So it really helps the guys out who are 640 looking at a condo, because normally it's going to be 4% just for them to even get a rate. Now they can, and maybe not actually 4%, but it is pretty high if you're looking for a condo, low down payment, and low credit scores. This equalizes all of it, whether you're looking at a townhouse, single family, manufactured, same rates, same credit scores all the same rate. So really cool program for that. We had someone that they were buying a condo and the rate was cheaper, decent credit, and she had a little bit of chunk of change to throw around. And rate was actually cheaper for her because she didn't have enough to make a difference on the down payment for her to go with down payment assistance than to go with a regular loan. So there's little tips and tricks that we can throw in to make it happen. So question on that.
Can I add something on that? I'm gonna give you an example of where experience matters. I'm working with a client right now that has money that they could do a traditional loan. They could either go FHA or conventional 3% down, they have the 3%, they have the closing costs, not a problem. When I dug a little deeper to find out where are you getting that, they were pulling it out of a retirement account. What happens when you pull money out of a retirement account? It's taxable. So they were gonna pay a penalty, plus it's now taxable income. And I said, you know what, instead of doing that, we can go with a down payment assistance program. Their payment's actually lower because the interest rate was lower than what it would have been on a traditional loan. Because they were buying, well, they were looking at condos. I don't think they didn't end up getting a condo. But you know, that's where, if they had called 1-800-mortgage online, they would have got exactly what they asked for. And it's not the best for them. So, and then one other thing on the LLPAs, I know we've talked about this before, but there was rumors that they were going to be adding an additional price adjustment for anybody with a FICO or with a debt ratio over 40%. If you didn't hear last week, that was nixed and cut out. So at least a little bit of good news. And they're still trying to get the LLPAs reversed. You know, it was something that the Biden administration put in. And so if you are opposed to it, write your Congress people and tell them, hey, this is affecting my clients, and people with good credit shouldn't have to pay more to subsidize people that have less credit. So if that's something that you're passionate about, write that out so that
I thought they already.
they only reversed the 40%.
Which was gonna be huge because we don't really lock in a payment fully until they're clear to close. MI can change at any point. So you could have someone that's at 39% and then it's 40, 41%. Now they have to pay an extra $3,000 just to lock in their rate because of that change. So it was a big thing. So it's a really big win for us as well. So for this one, give you a little something to throw out there. Don't let the lack of a large down payment hold you back. A lot of people think they need 20, 40%, whatever the case may be. Ask them, push them on this. Where did you get that information? First off, then you know what you're dealing with. If it was their brother's, uncle's, sister's, daughter, whatever, you can really wash that out. They should be listening to the experts here. So when the market heats up, just remind them how all of you saw in 20 and 21. If you were down payment assistance, you were, maybe we'll get to you if these other offers don't pan out. But that was just the matter of fact. So do you want to lose out on the home of your dreams? Do you want to be priced out of the area just because you don't have a sizable down payment? Talk to our lender. Let's see if you do qualify and what you can do. So.
Real quick.
Yeah.
It's important to use someone like you guys that have good reputations with listing agents. That will matter. If you have a lender that you don't know with the down payment assistance, you're gonna be like. But if you have somebody like, oh, Jeanette and Tyler on the other end, I'm not kidding, it will work. That's really important.
You can throw in your who you beat. Okay.
Oh, we beat out I think I told you guys, but we beat out a cash offer with 100% down payment assistance because I called the listing agent. Happened to be on a Sunday, he happened to be driving and he had plenty of time to talk. But he got comfortable with me. So that's something that we always do for our clients is we call the listing agent. Janelle, when you were my listing agent, I called you. Hopefully that helped.
Oh, yes, thank you.
So I think it also helped that I had the same name as the buyer. Yes. Then she thought she was by the Evans.
Yeah, she did.
Had to remind
She
her.
still does.
So, but yes, that's one of the things that we do to try and help you get your offers accepted. As well as things like this, so you can meet other people that are in the community and get to know who's on the other side of your offer.
Any questions? There's a lot of info. So of course, if any other questions do come up later on, please feel free to reach on out.